Hi, hello, namaskara to everybody and warm welcome to my channel. Today we are going to discuss about the Union Budget 2026-27 which was presented by Finance Minister on February 1st, 2026. And there we'll be discussing on direct taxes, income tax, some of the key highlights with few important positive changes, what might impact you. Firstly, there is a new income tax law, new Income Tax Act 2025 to be enforced from 1st April 2026. It comes into existence on 1st of April 2026. And then there are rules and forms are simplified as mentioned by the finance minister, and it has to be notified, and soon we'll all get the simplified rules and the revised forms. And then there are no changes to the slab rates. The first change is on the revised returns timelines. Time duration has been extended to revise, right? So your taxpayers will also get more time to revise returns. The deadline for revising the ITRs has been extended from earlier due date of December 31st to March 31st. So there is an additional 3 months time which is available if there are any omissions or mistakes or errors which has happened in your original return. You can utilize this additional 3 months to file the revised return, but it will come with a small fee. If your total income is less than 5 lakhs, a fee of 1000 rupees is charged, and any other case it would be 5000. That means if your total income is greater than 5 lakhs, then there is a fee of 5000. Along with this, you will be able to revise the return till 31st March. The second change is on the filing of returns due date. There is a small change, not the entire change. The time duration extended by a month to file the return in certain cases. The filing calendar will now be staggered, and it is not one due date. Individuals filing with ITR 1 and 2 will still follow the July 31st due date, which is the old deadline, while non-audit businesses, trust, who are filing in the ITR 3 or 4 will be allowed an additional 1 month and can be filed till 31st August uh, as the new due date for them. So next important change is on the taxation of sovereign gold bonds, SGBs. Now the exemption is limited to original buyer only if held till redemption. The tax exemption on redemption of SGBs at maturity will continue only for bonds subscribed at the time of original issuance. Right, for the from the upcoming tax year, which is 2026-27, SGBs are excluded from capital gains taxes only if they are originally subscribed and held till redemption. That means anybody who is purchasing SGBs in the secondary market will not be eligible for any exemptions even if held till redemption, right? Only people or the person who has acquired or purchased during the original issuance will be eligible for the exemption. For an example, investor A has subscribed to 2017-18 fifth series and is holding the bonds till redemption. That means you can redeem it after the continuous 5 years. So when it is available, so if you are selling it after 5 years, you will be eligible for the exemptions, otherwise not. If you are 2017-18 is when it has been issued in during October 2017. If investor B purchases it in secondary market, they'll not, if they are redeeming it at the time of maturity, they'll not be eligible for the tax exemption. So that is the important change. If anybody has purchased during the means if anybody has purchased in secondary market, so it is advised to sell it before 1st April 2026, because you will not be getting the tax exemption after that. So it is always better to do that. to save the tax. If you are fine with the taxation changes, you can continue to hold till redemption or till maturity. Another important change is on the buyback of shares treatment. It is very important and beneficial to the shareholders. Why it is now aligned with capital gains tax treatment for all shareholders. At present, it is the capital gain is taxed as deemed dividend in the hands of all shareholders and taxed at their applicable tax rate, and there is no deduction towards cost of acquisition on such deemed dividend, right? So the cost of acquisitions will be carried forward, and it has to be utilized or adjusted towards any of the capital gains in the future. So that is how it is treated right now, which is not beneficial to the shareholders. With the changes, it will be taxed as capital gains at reduced rates at 12.5% for long-term capital gains and 20% for short-term capital gains. For promoters, an additional buyback tax is levied. This will make the effective tax outgo for buyback transactions at 22% for corporate promoters and 30% for non-corporate. Another important change is on Form 15G and H. There is no change to the form as such, but it is simplified in terms of the submission. So anybody can now submit their lower tax declaration to the depositories directly. That is depository participants like CDSL, NSDL for lower TDS deduction on interest, dividends, and income from mutual fund units, etc. So you can directly submit to them. In turn, they will submit the form to anybody who requires, instead of you submitting to multiple people. So with one window submission, you will be able to meet the requirement. The declaration will be forwarded to all companies and entities that pay the investors, right? And previously, taxpayers were required to submit the certificate to every fund house and other payers. To avoid this cumbersome process, amendment has been made to section 393 subsection 6 of the Income Tax Act 2025, which reduces the work to everybody, taxpayers, depository participants, and then any other payers as well. Next important change is on the foreign asset disclosure scheme, which has been introduced for small taxpayers. It is for a 6 months period. A scheme has been proposed under Finance Bill 2026 for nudging the non-compliant small taxpayers to provide their foreign asset disclosures as per the provisions of the Act. Right, so there is a requirement that you have to declare your foreign asset, and you have to declare your any income which is derived from the foreign asset. So both the things, if somebody is not doing, it is a final chance looks like that finance ministry wants to provide with this particular proposed scheme. Right, the scheme is divided into two parts, part A and B. Part A applies to taxpayers who did not make the foreign asset disclosure and income whose limit does not exceed 1 crore rupees. Right, for those cases, 30% of the value of assets and income not disclosed and 100% of the additional tax needs to be paid. That is one option. Second, part B, which deals with the cases wherein foreign income is disclosed but and taxed as well, but while the corresponding foreign assets are not disclosed in the return of income. So in such cases, default quantum, it should not be the value should not exceed 5 crores and a fee of rupees 1 lakh needs to be paid in those cases. There are changes towards penalty and prosecution, and effort is towards rationalization, and there is a rationalized prosecution framework also, which has been mentioned in the changes, right? A budget speech, and it is to reduce the prosecution risk, remove the criminality, and structured settlement, but with some additional higher cost. simplified proceeding, narrow dispute. The intention is to reduce the dispute, and assessing officer now can consider the updated return to go with the updated details. And then also there is a switch to simple imprisonment instead of rigorous imprisonment, which was included in the 1961 Act, with the duration reduced to max 2 years for cases, earlier cases with 7 years, and then it is 6 months where cases with 2 years duration, which was provided earlier. And also court can convert imprisonment into fine, right? That is an additional benefit. And then Black Money Act, less than 20 lakh assets, there is a immunity from prosecution. It is mainly to relieve some of the small foreign asset non-reporting cases. For them it is beneficial. And then there is a scheme for small taxpayer, wherein rule based automated process will enable obtaining the lower or nil deduction certificate instead of uh, filing an application with the assessing officer. So we have come to the end of the presentation, and I have tried to cover all the important changes in income tax and key changes which is helpful to you, or there is an additional procedure or tax. So I've tried to cover all those things. So thank you everyone for watching this episode. I'm signing off from this episode, and we'll meet you soon with another video with some of the important topics and discussions. Thank you.